Hello everyone, today's class we're going to wrap up chapter 7, and in the next two classes we left for this semester, we're going to review the content of the whole semester. We will point out the key contents, what you need to focus before the final, and then also we're going to review the homework number 4. And I hope after these next two classes, you will be fully prepared for the final exam. And we will talk about the rules about the final exam in the next class. Okay, so this class we're still going to focus on the content of chapter 7. So let me just open this slide in the PowerPoint application. Okay, so first thing, the homework number 4 will be available today, and it's due on November 23rd. So that's a week later, and it's due by the end of that day. Okay, and don't forget that you can only submit 3 times the answers to the Canvas system for homework number 4. Okay, not unlimited attempts anymore. Okay, today we're going to talk about the taxable income, and also how do you calculate your income tax, and then how do you have the real cash flow diagrams. How do you calculate the cash flow after you consider the original price, the original cost, plus the depreciation deduction, plus the taxable income, and then how do you get the final cash flow after all these considerations. And when you are going to make a decision, you want to focus on the after-tax cash flow diagrams, because that is your real cash flow after all of these monetary adjustments. Okay, so first thing is about the taxable income. I think this might be a concept you're all familiar with, especially for someone who is familiar. For those who is familiar with the tax return process, so taxable income is if you're running a business, okay, you have your gross income, which is your the money you receive in your cashier every day, okay, or in your account every day, and that is called gross income. And the gross income needs to minus all expenses, right? Because if you're running a business, you need to operate that business, you need to rent a place, you need to hire some people, right? You need to buy equipment, you need to pay for the utilities, all those expenses. You need to take that from the gross income, except capital investments. Okay, so your gross income minus all the expenses except capital investments. Capital investment is the lump sum you pay at the beginning of the business to let it run. Okay, so that investment is not included in the taxable income. Okay, and also you want to minus the depreciation deductions. Okay, so that is how you calculate your taxable income. Okay, so use this formula to calculate taxable income. And let's look at this example. So a company invested 100 million on an asset. Okay, so because this is the initial investment, so it is capital investment. Okay, which generates 1,500,000 of gross income during its tax year. So this is what gross income, right? And incurs operating expenses of 800,000. So that is your expenses. So you want to know this is the capital investment, and this is your gross income, and this is your expenses. The total depreciation deduction for the tax year equals 114,000. This is what? This is your depreciation deduction. All right. So now what is the taxable income? So using this formula, your taxable income should be gross income, which is 1,500,000 minus your expenses, except the capital investment. So expenses is 800,000, and also minus the depreciation deduction, which is 114,000. Okay. So based on this equation, your taxable income would be the result of this calculation. So let's see, what's that? One 500,000 minus 800,000 minus 114,000, which is 586,000. So this is your taxable income. And whenever you know the tax rate, you can multiply this number by the tax rate, and then you will find your tax owed to IRS. Okay? So whenever you want to calculate your tax, you always want to know your taxable income. That's the base where you can calculate the tax. And another concept is about the tax rate. Okay, so there are many ways to calculate tax, different systems. And one system is called effective or marginal corporate income tax rate. It's marginal. Why? Because it is based on some, on how much you earn in your gross income, and the tax rate is only based on the additional amount of your gross income, okay, compared to some base number, and we call those base numbers bracket. Okay, so let's just take a look at what this tax rate system is. So first, under this marginal corporate income tax rate, the more you earn, the higher tax rate you pay. Okay? That's reasonable. But the higher tax rate only affects the additional amount. Okay? That's why it's called marginal, because it's only based on the additional amount. Well, additional to what? To these numbers. Okay? So read this table. This is corporate federal income tax rate in 2006. So this year, 2020, the numbers might be different, okay? But the concept and the structure is the same. So what is said in this table is how much you earn and how much you pay for the rate, for the tax, okay? So first, this half, it gives you some brackets, okay? And so it's like some windows or brackets where you can, fill your gross income in. So for the first row, that bracket is the amount you earn from 0 to 50,000. Okay, so that is the first bracket. So whenever you earn less than 50,000, your tax rate will be 15% of that gross income. Okay, but if you earn more than 50,000 but under 75,000, then you need to fill up these two brackets. So the first 50,000 you earn, will multiply the 15% to have one part of your tax, okay? And whatever left of your gross income, in your gross income, remember that you earn more than 50,000, but the number is lower than 75, so there might be some left over when you take out the 50,000 to calculate for the first bracket, okay? So what is left needs to multiply the 25% rate. And that is the second part of your tax. And then you're gonna have the first part plus the second part, which is your total income tax. Okay, so let's check this example. This is exactly what I said. So you earn 74,000 a year maybe, and this number is bigger than 50,000, right? But lower than 75,000. So how do you calculate your income tax? First, you need to fill the 50,000 bracket. So the first 50,000, the tax rate is 15%, okay? So you need to use the 50,000 to time with 15%. And then whatever you have left in your gross income, which is 24,000. So 24,000 is what? Is 74,000 minus the first 5,000, right? So you have 24,000 left. And then those money needs to pay at the rate of 25%. Stop doing that. Okay, so this is how you calculate your income tax, and to simplify this system for you, okay, and I think we can think about this table as another table which you have different bracket to fill up with your gross income, okay, and then when you want to calculate your gross income tax, you just slice your taxable income into pieces and fill up that bracket table, which I will show you in the next slide, and apply a different tax rate to each of the tax brackets. So what you want to do is to slice your taxable income into pieces, and fill up the different tax bracket. Okay, now let's look at what type of table I'm talking about. So this is still the original tax rate table, and you want to translate that into something like this. So in this new green table, it is easy to use. So the original table actually is telling you that you have different brackets to fill up with your gross income depending on how much you earn, right? So taxable income bracket, the first column, from 0 to 50%. So that's the first 50,000. Excuse me. That's the first 50,000 you earn, right? And then for that part, your tax rate is 15%. And whatever left from 50,000 to 75,000, that part you need to use the tax rate of 25%. Okay, then if you still have additional amount, then if that amount is between the 75,000 to the 100,000, then that amount left need to use the 34% to calculate the tax, and so on. So you need to first slice your income into different brackets and fill it up. Okay, so I know it's still very confusing. Then let's just take a look at this table, okay, at this example. So suppose that a firm for a tax year has a gross income of this number. So this is your gross income for that firm. And expenses is 2 million something, and depreciation deduction is 1 million something. So what would be its taxable income and the federal income tax for the tax year? Okay, so first you need to use that equation to calculate the taxable income. Remember that equation is what? Is to use the gross income which is 5,270,000. That's the gross income minus the expenses, excluding the capital investment. So this number is already excluding the capital investment. So you can just take it out from the gross income. So 2,927,500. And then minus the depreciation deduction for that tax year, which is 1,874,300. So this is gonna be your taxable income, and that will be 468,200. Okay, so this is your taxable income. And then to calculate the tax, you need to slice this into pieces to fill up this table. What do I mean? So first, the 468,000 is higher than 50,000, and it's also higher than 75,000. It's higher than 100,000. It's higher than 335,000, but it is under 10 million. Okay, so you want to slice your gross income and fill this table, but you understand, you know that you're gonna fill up this, but not this, because your total income is under 10 million. Okay, so first, for this 468,200, you have first, it is made of 50,000. That's the first 50,000, right? And then you still have another 25,000, okay, which is between the 50,000 to 75,000, okay, and then you still have another 25,000 in this total taxable income, and also you have another 235,000 left, and then after that you still have 133,200 left. Okay, so all these pieces, they sum up together, and you will have 468,200. Okay, so the sum of them will be the total gross income. Okay, so that's what I mean to slice the total income into pieces, and you always want to slice them into 50,000, 25,000, the third 25,000, and the fourth 235,000, and so on. Okay, and you fill this up, and then you're gonna use this tax rate to time the income to have your tax owed. So it's gonna be 15% times 50,000, which is 7,500. Okay, and then the second bracket, 25% times 25,000, which is 6,250. And the third bracket is to use the 34% times 25,000, which is 8,500. And the fourth bracket is to use 39% times 235,000, which is 91,650. And then the last bracket, you didn't fill it up, but you still have a part of it. That's fine. So it's 34% times 133,200, which is 45,288. So then your total tax you are owed to the IRS will be the sum of this. Okay, and that will be this 159,188. Okay, so this is how you use this system to calculate taxable income. To slice the taxable income, and then to determine for each bracket how much tax you owe, and then you sum them up. Okay, and then after you know how to calculate the tax, then it comes to the real cash flow problem. So it's called after-tax economic analysis. Remember that before Chapter 7, all the cash flows we're talking about is we didn't talk about anything about tax or depreciation deduction. So we can assume that those are the before tax cash flows. Okay, or maybe they consider that, but they didn't mention that. But after Chapter 7, you need to focus on what is called after-tax cash flows. Okay, and so usually the problem will give you a before-tax cash flow, and then you will be given the tax rate, and also the system where you can check the depreciation deduction. Usually you will be using the GDS system. Okay, and then from that you can calculate your depreciation for every year, and then you're gonna take the depreciation from the before tax cash flows to have your taxable income for each year, and then you use the tax rate to multiply with the taxable income for each year, and then you will have your tax for each year, right? And then you take the tax out of your taxable income for each year, then you will have your after tax cash flow diagrams. So before we use that method, we need to look at this new concepts or terms. So the first one is RK, that is the revenues, or we can say that's the savings. Okay, if you use some new equipment to save energy or save the fees, that is the RK from the project. And this is the cash flow. This is the cash inflow from the project during period K. And EK is cash outflows during year K for deductible expenses. Okay, so you have some income, you have some outgoing cash flow, which is represented by EK. And so K is for the year, okay, for a period. Could be year, could be month, okay? And DK is the sum of all non-cash or book costs during year K, such as depreciation. Okay, so usually we use DK to represent the depreciation deduction for each year. And T is the effective income tax rate on ordinary income. So T is always given in the problem. And the capital TK is the income tax consequences during year K. So that's the tax you pay or you owe every year. And ATCFK is the after-tax cash flow for that year K. Okay, so those are just terms we use. And then we're going to use this table to calculate what is the after-tax cash flow based on the before-tax cash flow, based on the depreciation deduction system, and based on the tax rate. Okay, so in this table, we have different columns. The first column is the number of year. So it's if it's 0, it is the end of year 0, which is at the beginning, okay? And 1 means the end of year 1. N means the end of year N, okay? And then and also you have 2 N's. So you have 2 last years, which means in some cases, the first last year row, you're going to write down the expense or cash flow in that year. And the last N row means you're going to write the market value, the MV, in case you have that. If you don't have that, this row is going to be, this cell is going to be 0, okay? This cell is going to be 0. And so that's why we have 2 N rows, 2 last year rows, okay? So that's the first column. And then the second column, we call it column A, okay? So column A is the before tax cash flow, BTCF. So before you consider all the tax and deductible, you have a cash flow, original cash flow. So it's made of what? It's made of capital investment, okay? And then for each year, and the capital investment always occur at the beginning. So it's in the row of year 0. And after that, from year 1 to year N, from year 1 to year N, you will have some ordinary income or operation expenses. So it could be positive, it could be negative. That's all the net cash flow occur in every year, okay? And then in the end, except for those cash flow, you still have the market value if it's possible, okay? So this is the before tax cash flow, and we can use the PW method or the internal rate of return method to calculate if this project is a good one or a bad one based on the before tax cash flow. But it's not a real cash flow. Sometimes if your tax is significant, you need to consider that. So you need to focus on the after-tax cash flow, okay? So to have the after-tax cash flow, you need to consider the column B, which is the depreciation deduction column. So the first cell in column B is not available because we don't consider the deduction for the capital investment. So you don't have to fill this, okay? It's NA, not available. Or you can write a dash, or you can just leave it empty. And from the year 1 to year N, you're gonna have depreciation, okay? And in every year, okay? The depreciation, it depends on what kind of property you have, what class it is, and what is the depreciation, the recovery rate, okay? And what is the book value. So this is gonna be B times RK if you're using the GDS method, okay? Or in the problem, maybe you will be given the depreciation deduction for each year, okay? You just need to fill them up, fill the table up, okay? But you need to understand those numbers listed here will be positive numbers. And then you will have the column C, which is the taxable income column. So column C is always the number in column A minus the number in column B. So whenever you have this equation in the column head, it's easy to calculate. So first in this first column, first row, it's still NA, not available. You don't have to fill it up, but from year 1 to year N, you need to fill it up with a number which is the result from A, the cell in column A minus the number in column B. And we say that is the taxable income because that's your gross income minus your depreciation deduction. Okay, so that's the taxable income, TI. And this number can be negative or positive in sign. And then don't forget about the very last row, which is to talk about the market value. And this is gonna be the market value minus the book value. Okay. And then we need to think about the income tax, the column D. Okay. Column D is minus T times C. So T is the effective tax rate. Okay, so use tax rate times whatever you have in column C, okay, and then give it a minus, give it a negative signal, negative sign. That is what you have for every year. So this is how you fill up this column. And then don't forget about the very last row. It is still the minus T times whatever you have in the column C. Okay, and then the very last column is the after-tax cash flow column, which is the sum of whatever you have in column A plus whatever you got in column D. Okay, so for this, the first row, you just copy the capital investment. Okay, and don't forget about the capital investment. The sign is negative. And then for the row of year 1 and year n, you're gonna use A plus D, the number in the column A to plus number in column D to fill this up. That is your after tax cash flow, cash flows from operations. And then don't forget about the very last row. If you have market value, okay, it is still the MV, the MV in the column A plus whatever you have in this column D. Okay, so this is just a big table filled with equations and to teach you how to fill up this type of table. And then after you have this after-tax cash flow, you're gonna use the PW method or whatever method you learned from chapter 5 and 6 to calculate if it's bigger than 0 or not, to determine if this is a sound project or a bad one. So let's look at this example. So this is Ajax Semiconductor Company. It attempts to evaluate the profitability of adding another integrated circuit production line to its present operations. So there is a proposal. So how is the cash flow look like? The company would need to purchase 2 or more acres of land. So this is the cost for land. And the facility would cost 60 million. So that's another piece of cost at the beginning. That's for the facility. And have no net MV at the end of the 5 years. So for the facility, there is no MV, okay? But you need to understand for the land, you have the MV, you have the value left, okay? Because the land is the land, it's not depreciated. It's still there. So after 5 years, you still have 275,000 worthy land. That's kind of your MV, okay? And the facility could be depreciated using a GDS. So you're using GDS recovery period of 5 years. It's given. And increment of working capital would be required. So you need to hire some persons. And its estimated amount is 10 million. So this is a third piece of your in capital investment. So you have 3 parts of capital investment. And you want to also pay attention to this 10 million. This is also something you can use after 5 years. It still has that value. Okay, you hire that employees, and after 5 years, those persons they still can work. their skills are still valuable. So those so the 10 million plus the 275,000, this one and this one, this can be seen as the market value of your initial investment. Okay, but this 60 million of facility, it doesn't have any market value. That's the tricky part of this situation. Okay, gross income is expected to increase by 30 million per year. So after this new equipment, you are gonna have 30 million additional every year. So that is, that is your gross income. Okay, and operating expenses are estimated to be 8 million per year. Okay, so the firm's effective income tax rate is 40%. Okay, so this is all you know. And then you want to set up the table and determine the after-tax cash flow for this project. And after that, you want to use the after-tax cash flow to calculate if this is worthwhile, if this project is worthwhile or not, at the MARR as 12% per year. Okay, so here is the table you want to fill up. Or it's already filled up, but let's take a look at how do we come up with those numbers. Okay. So the first column, because your project have five years, so you're gonna have this 0, 1, 2, 3, 4, 5, 5. There are 2 5s. One is for the cash flow, the other 5 is for the MV. Okay, so this is for the MV. And the column A, it's before tax cash flow. Basically, it's just a copy of those numbers in the problem statement. So first, what is your capital investment? We said it has 3 parts. So the first part is 60 million for the facility, and because it's a investment, so it's negative. And then you need to hire a bunch of people. It's 10 million. It's also expense, so it's negative. And then you need to buy a piece of land, which is which costs 275,000. It's also an expense, so it's negative. Okay, so all of them, this is your initial capital investment. And then we said we don't need to fill up the first row, but we need to copy this number into the last row. So this is just the sum of these 3 numbers. Okay, and don't forget about the negative sign. And then every year you're gonna have what? It said you have 30 million gross income, but you have 8 million expenses. So what is your gross income? Your gross income for each year will be 30 million minus 8 million. That's how you get 22 million. That's your positive 22 million every year. Okay, so this 22 million, it comes from 30 million gross income minus the 8 million expenses for each year. Okay, because it happens to each year, so you're gonna repeat this 22 million for every year for 5 years. That's why we have 5 22 millions here. And in the very last row for the MV, why do we have a 10,275,000? Okay, this MV is from the piece of land and also the workforce. Okay, so the people you hire, you need 10 million. And then the piece of land you purchase at the beginning, it's worthy 275,000. So this amount of money, the value is still there. So, and they are valuable. So you can see it as type of market value. And because it's a market value, so it's positive. Okay. And so that's how we filled up the column A. And then column B is depreciation deduction for each year. So the way you get these numbers, okay, is that you check the table 7-3, okay, and then you find out the column for 5 years, and then you have the RK. So this is gonna be times R1, B times R2, and so on. Okay, so let me just check my textbook to see what is the RK for each year. Okay, so now I'm looking at the table 7-3. Imagine you're looking at that table as well. So for year 1, your R1 is 0.2. Wait a second, this is a... Yeah, so just use the table of 7-3, and then you have R1, R2, R3, R4, R5 to calculate this to calculate the depreciation deduction in the column B, and also those numbers should be positive. And then let's take a look at the column C. Okay, so column C is whatever you have in column A minus the number in column B. Okay, so this 10 million is the result of the number in column A, which is 22 million, minus the number in column B, which is 12 million, which is 10 million, and so on. Okay, and the last number in column C should be, based on this, should be MV minus BV. Okay, so MV is 10 million something, and BV 5 is 6 million. So the 10 million, so because BV5 of the production facility is this number, and the net MV5 is 0. Okay, remember that the facility cannot be depreciated. So at the end of the 5 year, it is the MV of that is 0. So a loss on disposal would be taken at the end of year 5. So that is why you have this negative 6,112,000 in the end of the column C. And in the column D, the numbers should be the result of the tax rate 40%, or we can say it's 0.4 times whatever you have in column C. And also don't don't forget about the negative sign before that in front of the number. And then in the last column, all these numbers should be whatever you have in column A plus what you have in column D. Okay, so this method looks complicated, but whenever you understand the structure and how do you come up with every figure, actually it's not that difficult to fill up. And to answer the second question about if the project is a sound one or not, you need to use this column to calculate the PW. Okay, if you're using the PW method, the present worth method, and to see if the present worth of all these cash flows is bigger than 0 or not. Okay, so this is all the content of chapter 7, and in the next class we're going to review the whole class, the whole semester, and then we also will going to review the homework number 4, before the final exam. Okay, and so for this problem, I mean for the after-tax cash flow problem, we are not going to include this problem in the homework number 4 because we just learned it today. There's no time to add the question in homework number 4, but in the final exam we might have that in the very last question, because this is a very comprehensive problem which includes the method of present worth, and that is what you learn in chapters 6 and 5, and it also includes the tax, how do you calculate the tax, how do you calculate depreciation deduction. So this problem is very comprehensive, and it might be included in the final exam. Okay, so that I can test if you guys can understand all the contents in the different chapters and connect to the methods together. Okay, so that's it for today's class, and I will see you in the